Hi, we're Group 10. In this short video, we'll be talking through our research proposal in detail. But why monkey business, do you ask? What does that have to do with financial markets or trading? That's a good question. You'll soon find the answer to that. Let's start with our research question. Can a monkey outperform actively and passively managed funds in the stock market? This sounds like an absurd question. I mean, monkeys don't know anything about the stock market, right? But let's take a moment to think a little about the logic behind this question. Most of us know that the stock market is a highly unpredictable and volatile place. This is summarized by the theory that stock prices follow a random walk model, suggesting that past movement of the stock price or market cannot be used to predict its future movement. Based on this theory, one can safely say that there is no accurate model that exists that can predict price movements in the market. Yet, there is a high demand for professional fund managers who do massive amounts of research and analysis on how the stock market is going to move and try to make a return from it. Our task for this project is to find out if the research and the work that they do is actually fruitful, or if they are better off picking stocks at random. This is where our monkey comes in. Since a monkey knows nothing about the stock market, our random portfolio is just as good as one that is chosen by a monkey throwing darts at a dartboard. If the random walk model really does hold, then this means our monkey may actually be a real contender for the fund manager. There are already several articles on how seemingly randomly generated stock portfolios have beaten professionals with years of experience in the sector. Many professionals claim that they are able to beat the market returns. We will put this to the test by seeing if our monkey is able to do as well, if not better, using our own proposed methodology. Next, let's take a look at some of the previous studies that further support our research. The underlying idea of our research is actually taken from Burton Malkiel's book, A Random Walk Down Wall Street, where he claims that stock prices evolve according to random walk, hence, stock prices cannot be predicted. It is in line with the efficient market hypothesis too, especially the strong form where current stock prices already reflect all public and private information. Hence, it is impossible to achieve the result consistently and implies that both technical and fundamental analysis are useless. The Observer, a team under The Guardian, an influential daily newspaper published in London, created a portfolio challenge. In this challenge, they tried to prove whether a group of stock-picking professionals, wealth managers of Seven Investment Management, stockbrokers of Paul Kavanagh, and fund manager of Killick & Co., students from John Warner School, or a cat will win this portfolio challenge. Each team invested £5,000 in 5 companies from FTSE All Share Index in January 2012 and were allowed to exchange any stocks or replace them with others from the index. The challenge ended in the end of the year. Both students and professional fund managers used investment knowledge and their stock-picking methods, while the cat will throw his favorite toy mouse on a grid of numbers allocated to different companies. The results supported the random walk hypothesis, as the cat generated £542 in profit, followed by £176 by professionals and minus £160 by the students. In a paper titled The Surprising Alpha from Malkiel's Monkey and Upside Down Strategy, Arnott proved that a monkey-selected portfolio performed better than the S&P 500. A monkey randomly throwing darts has no skill in evaluating investments, and this was simulated by picking 30 random stocks from the US 1,000 largest stocks by market capitalization. The S&P 500 shows professional strategies to beat the market using CAP-M strategy. The experiment was done from 1998 to 2005, and the monkey was allowed to rebalance the portfolio annually. Arnott suspected that the monkey, which does not use any weight to the stocks chosen, would overweigh the high-risk stocks and underweigh the low-risk stocks. Arnott also concluded that value and size arise naturally in non-price-weighted strategies and constitute their return advantage. So next we are ready to set up our research. Here we'll discuss exactly how our experiment will run. But before that, let's set our assumptions. First of all, we will focus on the Singaporean market and select stocks that are listed on the Singapore Stock Exchange. We will invest 100,000 Singapore dollars on each of the 3 funds. Finally, no rebalancing will be done by the Monkey Fund. And now for the approach that we are going to use. For the Monkey portfolio, we will need to extract historical prices for stocks listed on the Singapore Stock Exchange and randomly choose 30 out of the total stocks listed on the exchange. In order to aid us to extract information efficiently, we are going to make use of Excel VBA to allow us to get historical prices of the relevant stocks that we are looking at from the internet or Bloomberg. For passively managed funds, we are going to use data from the Straits Times Index from 2000 to 2010. Finally, we'll use Aberdeen Singapore Equity Fund and Lion Global Singapore Trust to represent our actively managed fund. Once we have the data we need, we'll let the Monkey create a random portfolio of 30 stocks from the Singapore Stock Exchange. Upon construction of the randomized portfolio, we'll calculate its returns over the short-term 1-year, medium-term 5-year and long-term 10-year, given 100,000 Singapore dollar initial investment. The return will be the average return of the chosen 30 stocks. In this calculation, we will reinvest the dividends received and take into consideration brokerage fees when buying the stocks. The processes that we have gone through was to compare the portfolio returns against the market returns. We will use the same methodology to compare the returns from the randomized portfolio against that of actively managed funds in Singapore. This will be the average return of the 2 mentioned funds in the previous slide, given that we invest in both funds equally with 100,000 Singapore dollar initial investment. The returns of the actively managed portfolio will be adjusted for factors such as management fees and performance fees, if any. We will compare the Monkey portfolio's performance with the STI's performance too, for the short-term, medium-term and long-term. We will repeat the process 1,000 times for the random portfolio generation for 1, 5 and 10 years to achieve consistent results. So, what do we expect will be the outcome of our research project? We expect that the Monkey portfolio might beat the STI and actively managed funds in the short run. We should also note that the Monkey has no risk aversion, as it selects its stocks entirely at random. But we suspect that the tables will turn in the long run, and the Monkey fund will perform poorer in terms of returns generated. Our rationale behind this is that randomly chosen stocks will be riskier compared to the market capitalization-based stocks that form the STI. Therefore, the stocks of the randomized portfolio might generate better returns in the short term. Conversely, in the long run, we expect the returns of actively managed portfolio funds to beat the Monkey fund. However, if we include management and administrative fees, the returns from the active fund and the randomized funds might be relatively close. So that's it for our research proposal. Thank you for listening.